Good evening, ladies and gentlemen. I would like to extend a warm welcome to all my colleagues here from Ujjivan and all the guests who have gathered for our investor and analyst meet today. We appreciate your presence to be a part of our story in building a mass market bank. I, Akash Jaiswal from Investor Relations team of the bank is your host tonight. Similar to the last time that we had met in June 23, we are here today to present you an update on our bank strategy and outlook, which will be shared by a team present here today. The presentation has been uploaded on exchanges and on our website. A recording of this event would be available on YouTube later this month. And also for everyone's convenience, a QR code is visible on the back of the chair that is present in front of you. Guests may scan the QR code and view the presentation on their personal devices. So apart from this presentation, we have also put a digital kiosk outside where you can experience the digital FD and the digital SA product of our bank. This is one of the many digital products the bank is offering, and I request the guests to have a live experience to understand our simplified customer onboarding process, focusing on the digital product offering and serving the masses. More on the digital piece will be covered during the presentation. I will now ask our MD and CEO, Mr. Ittira Davis, to take the podium and to present his thoughts. Over to you, sir.
I think we have a full agenda for you today to cover various aspects of our business. Once again, I extend my welcome to that of Akash and say thank you for coming here and being with us and allowing us to take you through the changes that have happened since we came here last year. Last year was the first, this official face-to-face interaction that we had, especially after COVID. And this is the second one, and we hope that we'll be able to continue this on an annual basis. So let me start by, going through some of the numbers. You have seen these numbers, and you have seen these during the presentation which we had. We had a good profit of 1,100 crores in financial year 23. That has grown to 1,281 in financial year 24. And what is also important is that the other numbers that stack up, the net interest margin, return on assets, return on equity, are by far among the best in the industry. And in recognition of what we have achieved in financial year 23, the business today, along with KPMG, awarded Ujjivan in March this year the best small finance bank. And I think that is a recognition of the way we have turned around. And even the Reserve Bank of India has acknowledged that the turnaround that they have seen in Ujjivan is second to none. Within 1 year of the COVID, of getting past COVID, we have turned it around and made it into a very profitable operation. And to confirm that it is sustainable, that has continued into the next financial year 24. And we are hopeful that for the results of 24 as well, we'll be able to hold on to our position as the best small finance bank. Now, having said that, there are some of the important things that I'd like to talk about that has happened between last year and this year. Most of all, we have just completed the reverse merger. The completion of the reverse merger now has only one Ujjivan entity listed on the stock exchanges, and that is important by way of how we move forward. We have also continued to expand our geographical presence. We have added in the last year 2 new states, Telangana and Andhra Pradesh have been added, and the presence in those 2 states will grow as we move forward. The other is the important part which set upon about portfolio diversification. We have crossed 30% on the secured portfolio, while 70% unsecured. As we move forward with the diversification, the intent is to take that 30% secured portfolio towards 40%. And this year, by the end of financial year 25, we hope to be able to get to 35%, and by financial year 26, we will be able to get to 40%. With that diversification, 40-60, I think we will be in a very good position vis-a-vis the portfolio and other objectives that we have. The other part of it is, of course, the strong asset quality. The NPAs, GNPA have been brought well under control, and that is something that is important in this business. Finally, before we look at we have also had very good deposit ratios, both in terms of the CASA is growing. We haven't yet got to the 30%, but we are moving in that direction. And we also have built up a good deposit base on the term deposits as well. And all in all, I think the overall returns are important, and I think that is something that you will continue to see. Now, before I talk about the management changes that have taken place or will take place, I'd like to just mention something that will be discussed as we go along this evening. We have seen some stress in the market in the areas which we operate. And as a result of that, we have done in the last 2-3 weeks, we have done a very intensive study down to the branches and to each of the clusters that we operate in, trying to understand exactly what this is. This is something that we have learned during COVID and managing the COVID situation. And to be able to get the situation from the ground and move and react quickly as possible, so that we contain any situation if it is a negative situation. And to that extent, I think we are now making some changes to our guidance from what we had given earlier. In terms of the loan growth, we had given a range of 20 to 25%. Now, based on what is happening in the market, we are seeing that the growth for this year, based on the current trends, is likely to be towards the lower end, towards 20%. And why that is the case, we will get into more details later, but that is partly due to the fact that the current situation which we are seeing, we expect that to continue for the first half of the year, rather than just it was going to be an aberration for 1 or 2 months. We see the slowdown in this business happening because of us trying to identify good areas of operation as against areas which are under stress. So while doing that, we feel that that situation will continue for perhaps the whole of the first half of the year. Things we expect, our expectation is in the second half of the year that things will settle down and we will go back to what is a normal operation. So we have built that factor in, and that is why we have given the change in the growth. And it is also linked to the credit cost. Our credit cost, we had indicated the upper range as 1.5%. We are now moving that upwards to 1.7, and I think my colleague Ashish will take you through that when his section of the presentation comes as to why that is the case. And from the microfinance or microbanking side, Vibhas will tell you the other part of what we have picked up from the ground. Now, obviously, if there's a slowdown in the loan book, our deposit growth will continue in line with the loan book growth. We believe that our deposits will continue to be attractive to the customers, and we will have a good position there. Net interest margin, we don't see any change. We had indicated 9%. We stick by the 9%. The last ratio which we had mentioned was the return on equity. That is slightly lower than what we had indicated earlier, and that is based on the lower growth in the loan book and in the credit cost. We thought it is important, we finished this study just a few days ago. In terms of transparency, we thought it is right that we should at least bring it to your attention at this meeting. And this has also been uploaded in the stock exchanges, so it is available to everybody. Now I just move down onto the changes in management. In May this year, the Reserve Bank approved the appointment of Carol Furtado, a very old timer and a experienced person within Ujjivan, as executive director. So she has taken over that role, and she'll be there as the ED from now onwards. And then in May this year, early May, RBI approved the appointment of Mr. Sanjeev Nautiyal as the new managing director and CEO of Ujjivan. He will take over that role on the 1st of July. Now, Mr. Nautiyal is a very experienced banker. He has been with the State Bank of India for 37 years and has spent a time in all parts of banking, including having had an overseas assignment in Bahrain and responsible for the Gulf region. And in his last assignment, he was handling financial inclusion and had a very extensive experience in all parts of putting together a new sort of vertical within State Bank of India, which was focusing on the underserved and the unserved. And I think in the current circumstances, there's no better person than him to take over. The other most interesting thing that has happened recently is the RBI announcing the universal bank conditions, the transition of small finance banks into universal banks. And as of today, 2 small finance banks qualify for that, and one of them happens to be Ujjivan. So during this year, the board and the management will deliberate. We have already put in place a management team which will be looking into that, and will be working with the board to take a final decision on when and how to apply for this transition. So that is something which is happening, and that is a very interesting development, and something that Mr. Nautiyal will be the right person to take the bank forward in these circumstances. So with that, I would like to say, this is my last interaction as MD and CEO. I'll be stepping down on June 30th, but I'll be around with Ujjivan for a little while longer, and look forward to seeing you on other occasions. So I'd now like to hand over to Carol Furtado to take us through the next set of presentation on the businesses. So thank you very much.
Thank you, Mr. Davis. Good evening to all our guests and colleagues gathered here. As Mr. Davis said in his address, we have delivered on our promises and continue to uphold our commitments. I would like to share the remarkable journey of our bank in financial year 24, which was a year of growth for us. Business volumes have continued to grow strongly. Our quarterly average disbursements have grown consistently in FY24 over the previous year. The result is visible in our year-on-year book growth at 24%. On the liability side, the primary focus of the bank is to continue building a strong retail liability base, which is sustainable, scalable, and cost-effective. The aim is to attract, retain retail customers with good customer service through various delivery channels, value-add services, and designing products that are fine-tuned to every customer segment. Last year, as stated, we introduced digital fixed deposits and digital savings accounts. This is yielding us good results, and now we have the ability to acquire and service customers beyond branch boundaries. In a short period, we also acquired retail customer deposits from 120 locations where we do not have branches. Martin, our Chief Operating Officer, will talk on this in detail. Our continued focus on increasing brand visibility has been successful. We will continue to invest in creating brand awareness in all media. The successful campaigns, along with our focus on customer segmented approach, resulted in the deposit book growing over 2 times in the last 10 quarters, with significant CASA growth of approximately 160% during the same period. Dependency on bulk deposits is decreasing due to the strong measures taken to grow our retail deposit base. Bulk deposits has dropped below 30% of our total deposits as on March 24. The secured asset contribution continues to increase consistently, and we are well on our way to meet the 60-40 guidance, 40% in the secured asset portfolio, as Mr. Davis said, in FY26. Our affordable housing business did extremely well last financial year with a growth of over 45% over the previous financial year. These strategy changes made in housing, including having a localized collateral policy, has yielded good results. The affordable housing business is the largest contributor of growth in the secured asset portfolio. You will see more details in the housing presentation by Rishu Kumar, National Business Manager, Housing and Micro Mortgages. Similarly, we made significant strategy changes in MSME, which were implemented throughout FY24. In the last year, we made changes in customer segments, introduced new product variants, and programs based on financials and surrogate income, supplemented the credit underwriting with digital means, and relooked at our geographies with the aim to deepen our presence in the geographies we are present. All these took a little longer than expected. However, these strategy changes have now enabled the MSME business to start contributing to the top-line growth. Ashim Sarkar, head of MSME business, will talk in detail in his presentation. Microbanking continues to be a key business line in terms of growth and profitability. This business, as you all know, works on periods of cyclical stress. Our business model is built to sustain turbulent times. Even though we may be entering a period of stress in few pockets across the country, our experience and ability to manage various situations across the years through proactive measures will see us navigating this period cautiously. You will see that our portfolio is far better than our industry peers. Both Vibhas Chandra, head of microbanking, and Ashish Goel, chief credit officer, will cover this in detail in their presentations. This year, we are even more prepared with a strong collections team and the support of analytics to understand the indebtedness of the customers at varied intervals. This is in addition to the ground-level market intelligence that has been always our mainstay. Significant investments have been made in increasing and deepening our geographical presence, technology, and people. We have opened 177 branches in the last 2 years. These branches are contributing to the portfolio growth. We now have loan originating systems for each of our business verticals in place. Our objective is to fully utilize the investments made in technology and achieve higher levels of productivity, faster decisioning, and turnaround time for our customers. Also better cost efficiencies and thereby profitability. We continue to diversify our revenue streams through fee-based products. We have entered into all aspects of insurance products. We offer life, general, and health insurance products to our customers. Last year, we started 3-in-1 account comprising of DMAT and trading account, NPS, and APY for our customers. We also received the annual Exemplary Award of Par Excellence for Persistency from PFRDA and placed third overall in the FY24 PFRDA APY drives amongst SFBs, with our persistency being greater than 98% plus. Fee-based income will continue to have a significant growth in this financial year also. We aspire to be a partner in progress throughout our customers' life cycle by introducing products and services that is required by the customers in their journey. We have filled the gaps and introduced products that will support customers move up the economic ladder. Micro mortgages, which was introduced last year, has seen a good uptake and is meeting the needs of the customer. Additionally, we are moving into newer segments such as gold loans and vehicle loans, which are needed to serve our expanding customer base. I will take you through the 2 new business lines that will grow this year, vehicle loans and gold loans. They have the potential to significantly contribute to the NIMs and profitability and also falls in line with the requirements of the customer. Vehicle loans, which started in a small way pre-COVID, had its challenges to scale up, mainly in terms of positioning the product, target segment, and lack of technology to provide quick decisioning at the dealer points. We now have redone the strategy and have a new team in place led by an experienced banker selected internally. The business has revived by redefining processes, introduction of technology, a fully enabled loan originating system at the dealer outlet. We also have the scorecard-based approach and risk-based pricing, enabling a market competitive decisioning TAT. Processes have been streamlined and simplified. For example, by achieving reduction in documentation requirements by 50% and adoption of digital mandates has resulted in increased ease in customer onboarding and also their repayments. We have streamlined geographies which will offer two-wheeler loans. Our strategy is to emerge as the top 3 lenders in the dealerships we are present. We will deepen our presence in 9 states this year and expand the dealership networks. We offer products to commuters and mid-premium segments. The sourcing model is dealership-driven and also through referrals. We have also started funding electric two-wheelers and three-wheelers. These initiatives will enable us to double the productivity levels this year with an estimated book growth of 3 times. Gold loan is a new business segment for the bank. We launched gold loans last year. We find this a logical expansion of our product suite for customers who require short-term funding for business, short-term household expenses, and in rural areas for agricultural activities. Sourcing through referrals and cross-sell will form close to 75% of the total sourcing this year. Technology is in place, which will enable a quicker turnaround time. Currently, gold loans are being offered in 63 branches across 5 states. This will increase to 259 branches across 15 states this year, and with an expected book growth over 15 times as the base is low. In both vehicle loans and gold loans, we have started from a low base. This has seen a sharp increase in late last year, and we will achieve break-even in the next financial year. To conclude, microbanking has performed well during the last 2 years. However, we have seen certain levels of stress building in this business. Our focus will be to navigate the microbanking portfolio through this period effectively through careful monitoring and dynamic action plans at the branch level. A key focus is to improve the secured and unsecured portfolio mix. The new products introduced are all in the secured asset space. Even though we are a well-diversified bank in terms of customer segments, geographical distribution, assets liabilities mix, product mix, varied loan ticket sizes, risk management, this year we should see a scale-up of the secured asset portfolio by increasing contribution of high-yielding products such as micromortgages, vehicle loans, and gold loans, and also a strong focus on increasing CASA to reduce our cost of funds. We will continue investments in areas that will enhance our productivity and efficiencies, though cost to income may seem elevated at the current levels. Our investments are made to reap benefits in the long run. For example, the loan originating system are now operational for all the secured assets. This will enable a higher productivity, improved data accuracy, and faster decisioning for our customers. We are continuously strengthening our liability base by enabling customers to bank with us digitally and through easy and convenient delivery channels. This year, the focus will be to strengthen the deposit franchise through digital fixed deposits, digital savings accounts, and digital current accounts for individuals and proprietorships. Last but not the least, we will continue to leverage technology for growth and make ourselves into an increasingly technology-driven bank for the future. Now I will hand over to Joshua Raja, National Business Manager, Branch Banking. Joshua has been with Ujjivan for the past 16 years and has held business roles across various geographies. He currently leads the branch banking vertical of the bank. He will talk in detail about the liability strategy and its way forward. Thank you.
Thank you, Carol ma'am. Good evening to one and all. I will take you through what we did in the last year and our focus areas for this financial year. The bank's foremost focus is to develop a retail liability franchise which is stable, scalable, and cost-effective. Our aim is to attract and retain retail customers along with building a long-term relationship with them. The objective is to bring in granular retail deposits through a customer segment focus. In order to provide exceptional and customized banking services to our customers, we initiated a relationship manager module. This was done to build a relationship with customers and introduce them to various products and services of the bank. Through the RM relationship managers, we were able to get the customers to increase their wallet share with us. One of the initiatives the channel had undertaken was to reduce cost of funds. In line with that, the savings rate of interest was reduced from 6% to 5% during second half of the last year and still continue to hold on customer accounts. We have launched products and services by understanding the needs and requirements of each of the customer segments. Competition benchmarking, along with the customer surveys or additional checks done before launching any new product. Maxima Savings and Current Account, Navaratna are some of the new products and services launched to cater to specific customer segments. Initiatives to increase branding both at national and regional level was undertaken during the last financial year. This not only helped in business generation, but also helped in building brand recall within customers, both in existing and new customers. Various events during festivals, advertisements in newspapers and on TV and BTL activities were conducted during the last financial year. We also started acquiring customers through digital modes by extensively using channels such as video banking and video KYC. The primary objective for the vertical is to focus on retail deposits, retaining our existing customers through customized and preferential services along with cross-selling and upselling products based on their needs is one of the strategies followed. Our key objective is to increase the CASA ratio for the bank through quality customer acquisition and identifying the right target customer segment who will make us their primary banker. We have built internal synergies with other business verticals to help us achieve this goal. Customer service will continue to be a key differentiator, providing various channels and sources for customers to avail services such as through branches, phone banking, video banking, WhatsApp banking, and virtual relationship management services for customers to resolve their issues timely. The bank has adopted various distribution channels to increase its reach and presence. Apart from the physical presence, we have upgraded video KYC platform and digital platforms wherein customer can open their accounts digitally without the hassle of visiting a branch or an executive visiting their premises. Our extensive focus on retail has helped our deposits to grow over 2.2x over the last 30 months, wherein our CASA during this period has grown over 163%. This focus would continue going forward. Our customer base has been growing rapidly. From 64.8 lakhs during financial year 22, we have grown to 86 lakhs in financial year 24, a growth rate of 33%. On the individual customer side, the bank has grown by 7% from financial year 22 to financial year 24, thus reducing our dependency on institutional deposits by 7%. A clear positive indication that our dependency on bulk deposits has considerably reduced. On the deposit side, the book has grown by 23%. A customer segment focused approach for a bank involves tailoring products, services, and marketing strategies to meet the specific needs and preferences of distinct group within the customer base. The strategy can enhance customer satisfaction, increase retention, and drive growth. In addition to the customer segments that we have built over a period of time, we will focus on 3 more customer segments this financial year. India has a youth population of about 37 crores, which is 27% of total population. The primary requirement of youth customer is complete digital onboarding and seamless banking experience. Ujjivan SFB focuses on digital adoption and seamless services to provide enhanced customer experience. Total deposits of minor segment at industry level stands at 9 lakh crores, representing 5% of total banking deposits. These customers who are of age less than 18 years need disciplined investment options like FD, RD, along with easy access of account. We offer minor account with no minimum balance requirement, debit card facility, along with complete operations by Guardian. The total current account book size at an industry level is 19 lakhs crore, and this has sizable portion of retailer segments, mostly concentrated at tier 2 and tier 3 cities. The needs of these segments are low average monthly balance, digital mode of collections, and small ticket loans, etc. We offer charge-free banking services, value-added services like PASS, QR code, CMS facility, bank guarantee, and escrow accounts, higher cash limit to cater to these customer segments. This is a segment that our MSME team will target for working capital requirements. We will partner with them to provide a complete banking solution to these customers. To extend the focus on building stable retail liability base, the bank has taken 4 approach to garner stable funds at a very granular level. Customer segment and tailor-made products, channels, customers first service approach, cross-sell, upsell, and analytics. As a bank, we intend to segregate and focus on banking needs of important segments of the society by building products that are best suited to their specific needs. Keeping in mind customer convenience and the opportunities that comes with them, the bank has invested in creating multi-channel approach to engage with our customers. This helps us in expanding our reach beyond our physical branches through our carefully curated relationship banking module. Through the RM module, we not only address every customer service requirement at customer's residence, but also create opportunities for incremental businesses. To increase our customer touchpoints beyond branches, we also have fully functional phone banking, video banking, WhatsApp banking services, which will enable customers to communicate with us through any channel that suits them. At Ujjivan, we strive to keep customers' need utmost priority. For this, we have enabled self-service request for digitally onboarded customers, benchmark of service standard against competitors, service quality audit for the branches. To cater our customers' needs most efficiently, the bank has set up an extensive analytics vertical that helps with key insights on business process, systems, and products through advanced data modeling. To capture and cultivate referrals from our customers, we have in place a digital lead generation and tracking mechanism. Branding helps us in creating visibility along with generating more business opportunities. As an organization, we have always given importance on building the brand. Some of the initiatives that we have undertaken are implementation of BTL activities by the branches within their catchment area for all products to support business enhancement. TV brand campaigns for Independence and Republic Day, etc., were done to increase awareness of liability products, along with advertisements in leading newspaper, both at a national and regional level. All these were done in the local, regional languages that gave us wider reach. We are present on all major social networking websites and engage with customers on various posts periodically. Innovative large-scale campaigns such as the Onam Flower Carpet, which made us feature in the World Book of Record, gave us good visibility. We have enhanced engagement with media houses and have participated in new mediums such as podcast, YouTube interviews, magazine articles that give increased visibility to brand Ujjivan. On the way forward, increase liabilities book for the bank with incremental deposits from new and existing customers, increase customer base across all key segments by onboarding new relationship, referrals from existing customers, and extending banking relationship to family members. Prioritize acquisition and retention of low-cost funds of current and savings account deposits for the bank through segment-focused approach, customer-centric products, partnerships and alliances, relationship management, and customer service excellence. Reduce cost of funds by acquiring and retaining low-cost funds. focus and diverse plan strategy to make each and every branch and product offering profitable for the bank. Our foremost focus from retail liability perspective is to be the primary bank catering and fulfilling the banking needs of aspiring middle class segment by offering quality banking services. At the same time, attract and retain individual customers along with maintaining and building long-term relationship with them. The objective is to also bring in granular retail deposits at a low cost to build better profit margins. Product holding per customer is critical element in building consistent and stable customer relationship and thereby CASA values. Our strategy is to have a dedicated and regular customer connect virtually or physically to fulfill customers' requirements. We are constantly working on the employees from attracting the right talent and working with them for their growth by giving them sufficient training programs to have meaningful interactions with customers and service their requirements. I will now hand over to Asim Sarkar, Business Head MSME. He has been associated with Ujjivan since 2018 and has been pivotal in establishing the vertical from its inception. Under his leadership, Ujjivan SFB expanded its offerings to MSMEs, extending beyond term loans, thereby setting a robust working capital franchise through internal channels and various strategic alliances with fintechs. He will talk in detail about MSME strategy and the business outlook. Thank you.
Thank you, Joshua. Very good evening to all of our guests assembled here. I will start by introducing the micro, small, and medium enterprises vertical. Vertical which was one of the first secured lending verticals for Ujjivan. Now, in our journey, we have had considerable external challenges, and some of them have led to internal strategic realignment as well. Our moment of truth happened in FY23 when we were recovering from the COVID shock, and we decided to take a long, hard look at the entire business model of this vertical, going back to the basics of identifying a target micro, small, and medium enterprises customer segment for us that would be distinct in the Ujjivan perspective. And we also went about redesigning our own value proposition of how we will be attracting this target customer segment. Born out of that hard work is a resilient business that is now poised to take the leap towards a sustainable, scalable, and a profitable business banking franchise. Now, this entire strategic revamp has taken considerable amount of time. By our own admission, we would admit that we have been slow in getting back on the growth track in this vertical. But in my next slides, I'll take you through the considerable investment that we have made in this business that now give us a competitive advantage over our peers and also help us in building towards a customer segment that we would focus on in our journey towards becoming a universal bank. So FY24 was a pivotal year for us, following from the strategic revamp of FY23. And we have invested heavily in this year to prepare a more scalable model for us. Some of the highlights that we worked on in FY24, most important of them was in identifying a target customer segment for us that we would like to call semi-formal businesses that don't have audit of their business lines and formal businesses who are having formal audited business incomes. So we have studied these segments. We have mapped our offerings to the customer requirements in this segment, and I'll detail that out in the slides to come. We have thereby established distinct business lines to meet the short-term, the ultra-short-term, as well as the long-term cash flow requirements of these segments. There have been dedicated business as well as underwriting teams put in place to address these specific requirements, and I'll touch that upon in the slides. With setting up of these three business lines, we have now increased frontline presence in the markets that we are targeting to expand in. Our geographies have been carefully selected after detailed study of external data points as well as our internal competencies and our branch presence. And that gives us now the impetus to aim for the growth that we are targeting in FY25 and beyond. Most of our geography presence is now in semi-urban and a few urban locations, which we have detailed out in the slides. And finally, we have made large-scale investments in technology. And these technology investments are giving a digital enabler to our frontline teams, which gives them a competitive edge over our peers. All of these investments have been executed with the aim of providing a full stack financial offering to MSMEs. In this, I'm detailing out on this business segments that we have created to take you through the overall transition of the MSME space. There is continuing to be increasing formalization of MSMEs. We continue to see micro businesses starting to come under the GST ambit, which results in giving us more data trails that help us in better underwriting and also in improving their overall banking behavior, which falls in with our objective of getting the customer to bank with us. To cater to this business requirements, we have focused on a subset of semi-formal businesses. A semi-formal business for us is an MSME or a micro business that has registered under GST, is starting to have banking behavior, but may not have done the audit of the business line. We find that this is the ideal entry point for this vertical, and we partner with the customer in their journey of growth as they move towards increasing formalization. The overall objective remains to get the customer to be a full-fledged business banker to the customer and get the customer's liability relationship also with us in addition to meeting their cash flow requirements. To do this, we have dedicated business lines. On the long-term side, we have our legacy loan against property vertical, in which we have expanded our offerings, covering customers on the financial assessment as well as surrogate income assessments. We offered loan exposures up to 3 crore ticket size. We continue to be in a yield range between 11.5% to 12.5%. The idea is to build a sustainable and scalable portfolio on the LAP side, which gives me a funnel of customers whom we would want to become the business banker to, and whereby we would get them to have their working capital relationship also with us. So we have established a separate working capital vertical with a distinct business and a credit underwriting team, where we are going on exposures up to 5 CR, operating in yield ranges between 10.5% to 11.5% on the short-term side, with a significant additional share of fee income and liability income coming from this business banking customers. Our dedicated frontline not only acquires new customers for business banking, but are also graduating the legacy lab customers on the business banking side. And this is aided by the increasing formalization that we continue to see. Finally, we also have an anchor-led supply chain business, which is being managed through a central corporate anchor team, along with front lines being supported by the LAP and the WC team. In this, we are catering to MSME dealerships of corporate anchors through MOUs with the corporate anchor. And we are also now expanding on the MSME vendors of the corporate anchors. Here we are taking exposures up to 2 crore. And this is an entirely digital journey without any requirement of collateral, helping the customer to meet his urgent cash flow requirement with ease. With the 3 business lines now established in the last financial year, we are looking to have a significant growth in FY25 and beyond, targeting to have a portfolio growth in excess of 50%, whereby our short-term book share increases in excess of 20%. I have stressed multiple times on the investments that we have made. I would like to highlight 3 key execution drivers for us as we continue to scale up on the MSME space. The first is a relationship-based banking. We have dedicated relationship managers across all our business verticals on the lab side as well as the business banking side. The task of the relationship manager is to get the customer to bank with us, with a focus to increase the liability penetration on this customer. We are targeting sole banking in all our business banking relationships. We have built digital enablers for the front line. As Carol ma'am spoke of having dedicated loan origination systems, they are in place. Our underwriting is being done with digital support, focusing on customer data fetch at source, scorecards which are automating the credit journey, giving us best-in-class turnaround time for the customer. And more importantly, we have a real-time early warning system in place that is giving triggers to the front line on portfolio monitoring, leading to much better portfolio control. And finally, underlying all our investments and the scale-up plan is a very, very strong focus on profitability. From 2023 onwards, all of our new originations are on floating rate, which are linked to the repo rate. So we are covering ourselves on interest rate fluctuations. We are targeting to have a good mix of short-term and long-term fundings. Also, additional income on fee income and liability will help us to break even much, much faster. With that, We hope to see a significant progress in FY25 on the MSME portfolio and continued growth going forward. I would like to now hand over to Rishu, who will take you through the growth journey on housing and micro mortgages. Rishu has been with Ujjivan for a very, very long period of time, initially starting with the housing vertical on the business role, and he has also played a very pivotal journey in designing the product programs on the housing side. And it was very instrumental in starting our micro mortgages vertical, which now complements the affordable housing portfolio that we have. And both of these verticals have seen significant growth and have contributed to the secured share going up in the last financial year. So over to Rishu for taking us through that journey. Thank you.
Thanks, Asim. A very good evening to everyone. Affordable housing has been a journey which has been largely organic for us and our customers as well. We used to notice that many of our microfinance customers would be using the small ticket loans that we would be offering to them for household related activities, for example, renovation of their houses or expansion of their houses or house repair. And that is how we came to know that we need to design a customized product for our customers. And that is how our journey began in the beginning. It has been an eventful journey so far for our affordable housing business. We have covered this path from a non-player to a significant name in the affordable housing industry today. Last 2 years have been particularly rewarding for us, thanks to the efforts of the team on multiple parameters: product, process, people, and policy. Looking at the slide, you can see our growth vis-a-vis industry. We have literally grown at double the rate. Doubling our monthly disbursement over last 2 years with consistency reflects the solid foundation that we have put in place for this particular business. As I speak, we have proudly served more than 50,000 customers and have built a book of more than 5,000 crore. Geographical spread has been an strength, and it is going to propel our growth at a faster pace. Having a widespread business has two important benefits. One is obviously you avoid concentration risk, and second is as you grow your business in different states, you tend to develop an internal domain for each and every state, and this comes handy when you have to upscale or downscale your business in a particular state because of various reasons. We started our business with South and West and then slowly spread into North and East. Today, we are one of the fastest growing player in affordable housing industry. Customer's delight comes from the customer's journey if it is smooth and transparent. Basically, it should be a customer-led approach. We are trying to execute the same when we are talking about our customer journey with us. The process starts with a prospect who has immediate or future requirements for any credit facility in mind, but the prospect is yet not sure who the lender is going to be. Lead management system will catalyze the engagement with prospect to increase the conversion rate, that is from prospect to a customer. Loan origination system starts at a point when you figure in the priority list of your prospect. The customer starts the journey from here, and I can say with a lot of assurance that our current LOS is a masterpiece. From customer's perspective, eKYC is done in the beginning of the journey itself while customer onboarding. Documents are validated online through respective departmental portals. OTP-based validations are done to take customer's consent at each step wherever it is required. It has reduced the turnaround time, and journey for other products can always be taken in parallel on the same platform. If I talk the benefits of this for the bank, it has increased productivity of both the business and the credit team. Real-time MIS on various parameters can be pulled out at will. Various API integration has further opened this platform for multiple benefits. As you can see over here, repayment mandate gets registered through eNACH. eMudra will take care of the digital document signing. DSA connector management will make it easy to manage this significant channel for us. And as far as insurance and claim process is concerned, this process will also become seamless. Next phase of the journey is loan booking, which is taken care by the loan management system. The stage manages from loan disbursement till maturity. You may have many ad hoc requirements in the process, and everything is taken care by the loan management system over here. And last, but certainly not the least, is the customer service. All of us would agree that we have become a very demanding customer, irrespective of segment or product. This stage manages to address the same. We aim to serve the current and prospective customers with a basket of digital services. And to name a few, we are providing a tailor-made monthly smart statement which gives a holistic view about all the relationships the customer is having with us. WhatsApp banking is taking care of handling most of the queries which required a branch visit earlier. Looking at all the 4 stages in perspective, lead management system is something that we plan to roll out by H2 of this financial year. Whatever other features I have talked about just now, we are in the process of rolling out, and most of it have already been done. Moving to this year's plan for housing, we have identified key deliverables which will be instrumental in achieving our objectives for the business. We have already discussed digitizing process, and hence we'll move to the bottom line. Every customer and every employee needs to be profitable. At the end of the day, it has to be a healthy and symbiotic relationship. We are implementing unit-level profitability to ensure ownership at all levels in the organizational structure. India has 28 states, and as you know, here land laws are state-specific, and hence you cannot have one-size-fits-all solution. Our state-level collateral policy has been a high-impact initiative for us. It has given clarity to the team on sourcing as well as the type of collateral to accept. It has also helped us in having a better pricing mechanism. Retail asset centers are there in high potential locations where we decide to penetrate deep into the market, decentralize underwriting, disbursement, which ultimately helps in reducing the turnaround time, increase efficiency and overall control over business. We already have 18 such centers pan-India, and we plan to add 4 more in this financial year. Post-COVID, let me admit that we became a little more conservative. We started focusing more on salaried profile. But now we plan to have a healthy share of self-employed, non-professional category of segment as well. It has 2 basic benefits. One is it is obviously going to give you more business, and second is it gives you a better yield. Customer sourcing needs to be done in a systematic manner for this particular profile, particularly in Tier 2 and Tier 3 locations. Data analytics helps increase effectiveness of business in many ways. You want potential customers from existing to bank customer base. You want to increase your profitability by doing more cross-sell. Or you want to track the behavior of your customers, particularly credit behavior outside the bank. Data analytics comes in handy and gives you rare insights. Customer attrition is something which is not a challenge for us only, it is for everyone. Significant business gets done through balance transfer in mortgage industry. We have made a comprehensive policy to ensure higher customer stickiness. And to name a few, we identify vulnerable customers early on and start engaging with them very closely. We recommend multiple product relationship, and there is no rocket science in this. If you tie something with one thread, it is very easy to break. You have multi-product relationship, and the bond becomes very strong. We also have pre-qualified top-up loan. Top-up loan is something which is one of the major reasons why BT happens in the industry. So we identify such customers early on, and we propose them and let them know that this is your offering depending on their relationship with us. And at the end, we have a dedicated team at the regional level as well to ensure that customer retention policy becomes a success for us. If I talk about in numbers, more or less, if I compare this year with the last year, we had a significant drop in customer attrition. You have seen that we have quite a widespread presence across 22 states and 500 plus branches. Now the focus is to deep dive into these markets, which eventually increases your productivity, profitability, and helps you have a better control over business. Diversifying sourcing channel is instrumental to ensure perennial flow of business for the business team. Branch referral and customer referral are dependable and cost-effective channel, which has the potential to go a long way. Now let us move to the micro mortgages, our new business initiative, which caters to the credit needs of customers who want to graduate from micro lending type of product, but are yet not ready for our affordable housing proposition or the business loan product that we are having. So there is a huge chunk between these 2 business segments, and this is what we want to cater to through our micro mortgages business. End-use driven product suite has been designed for with products like micro lab, micro home improvement loan, and micro business loan. Considering the segment, the product and policy has been designed to match the customer's needs belonging to a specific income profile and location. The policy for Tamil Nadu has to be different from Gujarat or Maharashtra for that matter. Our sourcing strategy is clear and it is clearly defined for open market as well as existing to bank customer. While we have effective marketing mechanism to approach new to bank customers, we use a lot of data analytics to identify matured and needy customer from our internal pool. At present, if I talk about the share of customers, we have 50-50 ratio, 50% new to bank customer and 50% existing to bank customer for this particular business line. This is a high yield business which is going to contribute to bank's profitability significantly in coming years. We have a very nuanced credit underwriting mechanism thanks to our genesis that we understand these customers so well. This reflects in our on-time repayment rate for this business. Currently, it is 99% plus. Customer relationship is a critical area. If you don't manage your customers, maintain good relationship with your customer, you are going to lose them over time. After conducting pilot in 2022-23, we have worked out a detailed strategy to scale this business line. Today, we have made this product suite available in branches spread across 14 states. We have served more than 5,000 customers and counting every day. We are a meaningful player today in affordable housing industry. From here, we need to compete with the best and be one. Portfolio quality should be non-negotiable for any lending business. We envision our GNPA to be less than 1%. Bottom line matters to us as it is for any viable business. We have already started generating profit. Profitability will be a key deliverable, and we will ensure the same with rationalized ROI. For example, you cannot offer the same offering in terms of ROI to your customer profile of one particular segment in Gujarat as compared to some state in eastern India. It cannot be same in Mumbai as compared to Aurangabad. So it has to be very rationalized depending on location, customer profile, and the market reality. And that is exactly what we have done. Operational efficiency is another thing that we are trying to increase. A happy customer is a profitable customer. Turnaround time tops the chart in customer service score. 72 hours, that is something which is not easy in mortgage industry, particularly in informal segment of customers. But we have our plan well laid out and we are determined to deliver it sooner than later. Customers will be able to fulfill all their dreams from a single platform and much of the work has already been done. One thing is very clear, that we want to gain leadership position in affordable housing segment and we are aggressively moving in that direction. For now, we plan to grow at a rate of 40% on a year-on-year basis. So that is all from my side for now. Thank you so much for being an attentive audience. Now I would like to request Mr. Bibhas Chandra, who is a veteran of Ujjivan. He heads our micro banking business. Over to you, Bibhas, to take the session forward. Thank you.
Thank you, Rishu, and good evening, everybody. As we all know that microfinance is a place from where Ujjivan started and then we became a bank. And today also microfinance is a predominant business within Ujjivan. At the same time, in the last 20 years, if you see, the microfinance industry has also done very well. But what we believe, and what we actually started believing long back, that whatever has brought us here, today we have 8 crore customers in microfinance industry in the country, will not get us there. And there is much more potential left in microfinance in the country, but you have to do something else apart from what you are doing today. And that is what I wanted to discuss today, that how we have prepared ourselves for the future and the future growth. So starting with the last 9 quarter growth story of Ujjivan microfinance business, we have grown consistently quarter on quarter in the last 9 quarters. At the same time, we have crossed 50 lakh customer benchmark, and that is gold mine in itself. If you have 50 lakh customers, you can do a lot of things around that, because 50 lakh customers means 50 lakh families. And that is what we have been able to do in the last 3-4 years when we started Sampoon banking program. At the same time, if you remember in the last meet, we also said that IL is our strategy, because there are a lot of customers who are interested in graduating, and that we see that customers if don't get the right product, they also try to graduate to some other organization as well where they find logical products. And if you see, our IL has grown much faster than GL. IL growth has been over 50% for the last 2 years. Apart from that, we have also been able to garner deposit from the same customer segment, and this was our strategy when we became a bank, as we wanted to provide full range of financial services to our customers. And this liability business is being done by the same field staff who actually does the group loan or individual loan business. And today we have close to 2,500 crores garnered from the same customer segment. One thing is important in microfinance that we have seen and we have learned over the period of time, that geographical diversification is very important. We have witnessed Andhra crisis. We have seen what have happened in Assam, and right now also to an extent in small pockets happening in Punjab also. And it is very important that you diversify yourself in different states. And right from day one, we wanted to be a pan-India organization as far as microfinance business is concerned. And we are present everywhere except some of the states where we, at this point of time, we don't want to go. At the same time, it is also very important that you also diversify in your products. And we started doing IL program long back in 2010-11. And today, about 20% business comes from IL business, and mostly from graduation. But at the same time, within IL, where we disburse close to 300 to 400 crores every month, close to 20% customers also come from open market. And these are not new to credit customers. These are customers from other MFIs who have experience of microfinance and group loan, who want better products and don't get, and then come to us. And that is coming without any looking out for customers in our geography. It is customers are automatically coming. We also want to focus on these customers who have been in microfinance for some time, looking for a better product. And then we are also trying to target them through IL program, and then we have other programs as well. One thing that Kyle ma'am also mentioned in her speech, that we are seeing some pockets heating up, and it is not like entire state or a part of a state is heating up, but there are certain districts where we are seeing that there are certain issues that we are finding in terms of overlending or increasing number of default cases, but these cases are limited. At the same time, I would also like to tell you that we have learned over the period. We have learned during the demonetization. We have also learned during the pandemic how to battle such situation. And if you see the portfolio quality, this is one slice. We have various slices also, but this is just for representation that how we are looking against the average industry. Literally, in all states, our portfolio is behaving much better than the industry. We are almost at a half in most of the states. At the same time, if you take different cuts of different organizations, including banks, SFBs, NBSE, MFI, Ujjivan is much better than the industry. And there are reasons behind it. We have learned during demonetization that you need to have a independent and strong collection team, which was unheard of in microfinance industry. And today also it is almost insignificant. It is not available in many of the organizations. And it was very difficult to build, very tricky to build, because when you are dealing with such customer segment, which is little vulnerable, you have to build your collection team accordingly. Today we have 1,200 plus collection staff working across the branches, but the integral part of the team, but they are outsourced mostly. And that gives you flexibility of increasing or decreasing the headcount in collection team based on the requirement. And that is something which we have learned, and established during the demonetization and pandemic. From day one, we have independent credit team, which is again very unique to Ujjivan, unheard of in the industry, and that gives us a lot of confidence when we are acquiring customers. And that is something which we are on which we have built our IL program. We also have that we have used a lot of data, especially during pandemic, and after pandemic we have started using that. And 50 lakh customers, lot of credit bureau information, lot of internal information you have to assimilate. What Risu was saying in his presentation, that we have a lot of customers who want to graduate from IL to logically to MLab. We generally do it through data analytics. At the same time, as far as our collections are concerned, where to go, which customers, what is the customer's next step in case of we see the chances of default, we immediately catch hold of the customers. We try to understand their problem, try to solve it, and that is something which is helping us both in business as well as our collection and portfolio management. So this slide we have put just to showcase that how we are graduating our customers. When Risu was presenting, he said that we have a lot of customers and 50% customers in MLAP is coming from microfinance who are graduating from microfinance to MLAP product. Similarly, in two-wheeler also, we see a lot of customers interest in taking two-wheeler loan. About 10% customers are also from microfinance are going to two-wheeler. Gold loan, we have just started. We are seeing a good response from customer. And when at industry level, if you see that about 12 to 13% have overlap of gold loan, that gives the immense potential in this product. We find it very, very logical. And today we are in 60 branches, but by the end of this financial year, we will be available in close to 300 branches, which will do gold loan. At the same time, we also have a lot of customers where family members are interested in other products, including savings as well as the asset product. And we see that a lot of customers coming in. So far, we have garnered close to 10 lakh customers who are the family members of our microfinance customers. One thing is that, as Mr. Davis was mentioning, that this year we'll reach in secured from 30 to 35 and next year 35 to 40. One segment we also see that within microfinance, there are a lot of customers who are interested in graduating to secured product. And we have started MLAP program, we have started gold loan. And in a limited time, in the last 4 or 5 months, we see that 1% of our portfolio has been converted into secured. You will see a rapid growth in this portfolio as well going forward. And the 35% and 40% benchmark, there will be a contribution from microfinance customer segment as well. Digital is something which we were working on pre-pandemic also, but during pandemic and after pandemic, not only us, but our customer also learned the digital way, and today our digital repayment is close to 29%. And this helps us in two ways. First, it reduces your cost of collections. For example, if you go and collect EMI from a customer at doorstep, your cost is close to 30 rupees. The customer pays through UPI, your cost is still 10 rupees. If the customer pays through your saving account, Ujjivan saving account through SI, your cost is virtually 0 rupees. And that is what we are trying to do so that our cost of collection goes down. At the same time, customer also can conveniently pay their EMI. This is something which we showcased last time when we came here. We saw that we have launched a Hello Ujjivan application specifically built for microfinance customer segment. And you must be remembering that there was an outlet outside where we were showing that how it works. It is a VVV-based voice vernacular where the customers who are illiterate can also use. And after 1 year, when we have come back here, in the last 1 year, less than 1 year actually, more than 10 lakh microfinance customers have already downloaded it and using it. And that is a great success because 10 lakh, 1 million is not a small number. And with the with limited functionality so far, we have savings transaction facility. They can pay their EMI. They can also buy micro insurance product like Hospicash. Sounds very small, but at the same time for this customer segment, very, very useful. And this can be bought just by clicking a button. So far we have also built the loan acknowledgement part of the loan process in the Hello Ujjivan application. It also sounds very simple, but at the same time, if you look at microfinance operation, how it happens, the customer for each step has to meet somebody, either at the center meeting or they have to come to the branch all the way from 30 or 40 kilometers to sign some papers and get their loan. Today, instead of coming to the branch and spending their 2 hours, our customers can sit at their home and with a click of button, they can get their loan processed. And that is something which a lot of customers have started doing. Today, about 30 to 35% of our customers are actually not coming to our branches. Going forward, Hello Ujjivan is something on which we want to build our loan flows also, including the top up and repeat, where the customers can get their loan process sitting at their branch without meeting at their home, without meeting our customers. This will also unlock time for our staff to do some other activities and garner some other businesses. So today, you know that Ujjivan is considered to be one of the players in microfinance, which is respected because of the kind of technology innovation we bring to the table. And we believe that whatever have brought us here will not get us there. And we have started working on it for the last 4 or 5 years, so that we match the customer aspirations. Customer aspirations are changing very fast. Today, we have 8 crore customers in the industry, and the industry potential is close to 20 crores. There is a lot of head space to grow in the microfinance business. And it is very important that your group loan business, your JLG business grows. And for that, we have branches across the country. We have opened a lot of branches in the last 2 years also to ensure that we go to the places which are safer and the states where our penetration is lower. But at the same time, among the 8 crore customers also, and within the 50 lakh customer base that we have today, there are a lot of customers who are ready to graduate or graduating as we speak. These customers are customers who want to go beyond GLG. Their ticket size requirement has changed. Their purpose of loan has changed. And within microfinance and Ujjivan also, we see that 21 customers are actually every month getting converted, 20% month on month. This data will be true for the entire industry as well. Out of 8 crore, there are a lot of customers, to 20% or more, who are ready to graduate. And it is very important that you work on this customer segment as well, because these are cream of microfinance customers. Today we have IL program which is working very well, and we have been able to graduate a lot of customers in the last 3 years after pandemic. We have MLEP program where the customers, even they want higher ticket size loan, they can get. If they want two-wheeler loan, we already have a two-wheeler product where it is being sold to microfinance customers. If they want gold loan, we have started gold loan program in 60 branches and will be present in 300 branches with gold loan in this financial year. And if they want any other product for the family members, we have Sampoon banking program where we cater to the family needs of the customers. With all this and with the kind of data analytics platform we have built around the customers and to understand their requirement and proactively contact customer to sell our products, we believe that we will be able to serve both from 8 crore to 20 crore, and from within the 8 crore, whatever customers are ready to graduate, we will be able to cater to all both of the customer segment, and in the process become true in the mass market bank in a true sense. This is this is also based on the fact that microfinance industry has been growing at a certain rate, which is a little more than what the banking industry grows. With a little shocks here and there, we have seen Andhra crisis, we have seen demonetization, we have also seen the pandemic, and today small issues that is happening around some part of Punjab, some part of Haryana also, and then some part of Kerala, etc. With our limited exposure in these states and our robust credit and collection processes and team, we are very confident that we will be able to grow along this next 6 months as well and maintain our collections. And we also hope that and believe that it will be a matter of 4 to 6 months, and second half of the financial year will be much better than the first half of the financial year. Thank you so much, and I would like to welcome Ashish Goyal, who is our Chief Credit Officer. Thank you so much.
Thank you, Vivas, and welcome to all our guests here. When we met last year, we were talking about steady growth, steady GNPA, and steady NNPA, good asset quality, healthy asset quality to continue for the financial year FY24. We also said that there would be some kind of a normalization in the credit cost because our credit costs were negligible in the last 2 financial years. What we have done in the last year is what I would focus upon and also talk about what we plan to do in the next financial year. So as we had said last year, our credit cost has been maintained below 1%. In fact, the first half of the year did not see much of a normalization. So we were in the range of below 0.4% in the first half. But in the second half, there was some kind of a credit cost, but we maintained ourselves much below 1% for the full year. Our SMA portfolio continues to be good. We are at 1.4%. GNPA and PAR, we said we want to maintain consistency. So as you can see, we have GNPA as well as PAR maintained in a very steady range in the last 6 quarters. In fact, our GNPA and PAR have seen a volatility of not more than 0.1% in the last 4 to 5 quarters. On micro banking, our collection efficiency in the last 1 year has been between 99.7% to 99.8%, give or take 10 basis points. So there were a couple of months of 99.6 as well. So it has been a very steady journey on micro banking. And what you see here is the non-delinquent portfolio.
As delinquencies, as buckets go up, obviously the collection efficiency comes down. As Vibhas was mentioning, we've been very, very focused on our asset quality. The 24 MOB 30 plus par is what you see on that side. And 24 MOB 90 plus par is what you see on this side of the graph. We have been almost half to 1/3 of the industry. The second half, as I was mentioning, behaved a little differently from the first half. You would also have seen that our growth was 19% as against the industry growth of more than 25%. We had indeed slowed down in the second half of the year when we had started seeing some kind of aberrations in some states. We had deliberately slowed down. Our GL growth, therefore, you would see was much, much lower than 20%. IL, however, continued to be at a steady 40% plus. So compared to industry, we will continue to benchmark ourselves, and we will see that we continue to perform much, much better than the industry. So as I was talking about prudent growth in the last year, our growth in the second half was much lower. We wanted to do that, and therefore we had slowed down in certain states. We also put a team of almost 150 credit officers on the field in addition to what we were doing in the past. So we had indeed strengthened our field credit monitoring process. We also did some amount of process optimization to improve our efficiency. Our STP therefore went up from almost 20% to more than 40%, 45% for the year. This year, we are very, very micro-focused in terms of branch-level growth plans. Our growth in certain geographies, you will see that we have recalibrated. We are moderating growth in certain states. And some states will continue to grow at a normal pace. And this is being done at a branch level. It is being done at a relationship officer level also. We'll continue our focus on recoveries. Last year, we did almost 390 crore of cash collection from NPA accounts. Before that, 2 years were 600 crores and 600 crores. We'll continue our focus on right of bad debt recovery. Last year, we had spoken about 100 crore, but we delivered about 135 crores. So we expect this trend to continue in the coming year as well. This year also, we will do automation of our individual loan LOS. We should see a lot of improvement in efficiency coming from our LOS upgrade for individual loans this year. Housing portfolio, last year again, we had spoken about 60% coming from home loans, 60% coming from the formal segment, 60% coming from salaried. So we are more or less on the template, 61, 60, and 56% coming from this template. Our post-COVID book is now almost 73% of the book. And this is behaving, as you can see here, this new book which has been generated post-COVID is giving us 0.6% GNPA and 1.6% of portfolio at risk at 0+. I'll compare this with the industry also, but 70% of our book is now giving us a fairly stable GNPA and PAR. If I look at the overall book, we are currently at 1.5% GNPA and 3.9% PAR for the full book. How do we compare ourselves with the industry? On the bottom, you see a comparison with the industry for home loan on the left side and for LAP on the right side. We currently are at 0.7% home loan, 30 plus PAR, 24 MOP, 5 to 20 lakhs. So this is the affordable segment. We are currently at 0.7, much better than the industry. On LAP loans, we are at 0.78, slightly higher than home loan, but much better than the industry for a 30 plus 5 to 20 lakh segment. Our NDA collection pool efficiencies have held steady, 99.5 to 99.7. And 30 plus PAR and NPA, we had said that we want to be very steady. We don't want much volatility in the asset quality. And that is what I think these graphs indicate. Last year, we have done a robust growth. 20,000 customers post-COVID have grown to now 53,000 customers. We have a very well-diversified book. Vibhas was talking about diversification. It is now a very well-diversified book in the home loan as well as the LAP portfolio. Portfolio quality, as I said, was amongst the best. And every case is visited by a credit officer to do underwriting. So every customer as well as the property is personally underwritten by our credit officers. And we have very low exposure to under construction projects, which could be a little bit of a problem. We had seen some kind of stress during the COVID, but we have deliberately reduced our exposure there. And we have very negligible exposure now. We have, Rishu mentioned about LOS. We have a very good LOS now in place. Almost zero effort of data quality and zero effort of information being sourced from any outside domain. Everything is auto-fetched. Next year, again, recovery focus, we want to continue that. This is something that has given us good result in terms of asset quality in the last 2 financial years. We want the recovery effort to continue. We want to maintain our NDA collection pool efficiency to be 99.5 and above. We again will be strengthening our new LOS further. We want to do 100% digitization. Currently, we are not at 100%. We also want our digital repayments to grow from 96% currently to 98%. Capacity and training. This is the training that we've been giving for our staff on a quarterly basis. The training shall continue. We keep giving refresher courses through IIBF as well as internal trainings to all our team members. Micro mortgages a little more. In addition to what Rishu mentioned, the book is now 200 crore plus. Now, in terms of credit controls, we have a loan to value. This is what we have in the first phase of the book building, first 200 crores. Residential LTVs of about 34%, commercial of 32%, and mixed usage is about 27%. Our repayment modes are 100% SI. So therefore, you see that when we talk about our OTRR, it is 99.8%. So 99.8% of all our 4,000 customers pay on due date without any delays. Again, the entire credit team of micro mortgages is built from the individual loan credit underwriting team. So they are the ones who understood the 5 lakh, the 40,000-50,000 rupee income, household income customer. So they are the ones who are now who have now moved to micro mortgage underwriting. So entire team is built from individual loan credit background. Our ticket size are, similar to the industry at about 4.9 lakh. 50% of our customers are internal, and only 1% customers are new to credit. We had spoken about the challenges we had in the micro and small and medium enterprise book. We did in fact have high delinquencies in this book last year. The old book now is about 50% of the book. It has been steadily coming down. It is now in the range of about 700 crore. The new book is, again, has been growing steadily. It is now 700 crores. So the risk of our old portfolio has been contained by and large. We have not seen any increase in NPA in the old book. Our new book NPA is at 1.4% post 24 MOB. So this asset quality is also holding very well for us. In fact, in the last 12 months, not a single account has gone into 0+ par. So these new policies, new products are working very well for us in scaling up our MSME book. Last year, we did an LOS upgrade. So our TAT has got significantly improved. All data entry is now happening, digitally. Our credit assessment has got automated. So in terms of bank statement analyzer, GST, ITR, everything has now got digitized. So we are not spending time on doing those manual things. We have also integrated a BRE. So all deviations, etc., are fully populated on LOS. We've got a much better data quality now. In terms of collections, last year we had some very good collections. So we have seen a significant improvement in our 30+ and 90+ par in MSME last year. Ashim talked about widening of product suite. We will have a very good growth in working capital coming in the coming financial year. You will also see an accelerated growth in our fintech business, which is our partnerships, the supply chain part. So that would see a much faster growth. Being a digital product, it would be much faster than the branch-based products of LAP and working capital. Our recovery focus will continue. This year again, we will continue to stay invested in our collections team, and we should see a very healthy number in terms of our asset quality as well as bad debt recovery in MSME this year. A quick one on FIG portfolio. We diversified successfully into 9 sectors now in the last 3 financial years. None of the sectors gives us more than 30% exposure. We do rigorous monitoring of our financial covenants and portfolio on a quarterly basis. We also had about 67% growth in our FIG portfolio disbursements last financially. It was more than 1,500 crores, and 94% of our book is A- and above rated. So that gives us a lot of confidence on asset quality that we are underwriting. Last year, we also spoke about implementation of the collection system on retail, and we've successfully implemented that. Saved us about 70 to 80,000 manual receipts every month. All allocation of delinquent accounts happens on the system. The receipt management is completely digitized. In fact, we don't cut a single manual receipt now. Save a few whenever there are customers who walk into the branch. Trail history for every customer is now available. Geo-tagging for every customer is now available. We send payment links on our calls as well as on our visits whenever we go and visit customers. Phase 2 is also, as we talk, being implemented. So that will give us even better intuition in terms of our customers' repayment behavior. That's all from my side. I would now request Martin to come over for a brief on digital and IT. Thank you.
Thank you, Ashish. Good evening and welcome to all assembled here. In continuation to the business plans, you heard from my colleagues, Carol, Joshua, Ashim, on the various measures taken to build retail deposit and a diversified loan book. I will cover the areas on digital, data science, and technology to complement the business plans. Digital savings account was launched in December 23. Close to 4,000 customers have chosen this product. It is worthy to note that the average balance in these digital accounts are around 16,000 rupees, which is much above the balances we acquire through the branches. Digital FD was launched in July 23. Close to 8,000 customers have chosen this product. As we speak, we have crossed 100 crores in deposit through this channel. In addition to the 752 branch locations, we have acquired customers in 120 locations where we do not have a branch network. Some of these locations are in tier 3, tier 4 locations like Rangareddy, Balasore, Nagar. To make our savings account as a preferred account, we'll be coming up with an upgraded mobile banking and internet banking platform with 90 plus features. This upgraded platform is built on microservices based technology, which guarantees higher reliability. This supported by Digimitra, a unique service offered by our bank, will provide real-time support to our customers on technical or functional related queries. As on March, 3.5 million customers have subscribed to our mobile banking and internet banking channel, and we have garnered 1,500 crores deposit during the year. We have ranked number 2 on the UPI transactions. We have processed more than 37,000 crore transactions on UPI and 45,000 crores in value. The change in ranking is due to the merger of 2 small finance banks. To fuel the growth of current account, we'll be launching digital current account. The entire journey will be digital. To start with, we'll be offering this for individual current account and sole proprietorship current accounts. The journey will be seamlessly integrated with video KYC, GST, Udyam. That will help in attracting potential MSME customers also. We will be launching a mobile app exclusively for the current account customers. This will come with 200 plus features. This will surely make our current account as a preferred account for our customers. We'll also be offering merchant aggregator solution that will help our current account customers to monitor transaction at various outlets or counters. This is expected to be delivered by Q4. A combination of digital current account with cutting-edge features on digital channels will accelerate the growth of current account. We are ranked number 1 among the small finance bank on the ATM transaction, ranked 21st across the bank. We have moved up by 3 notches compared to the last year. By use of data science and analytics, we have been able to maintain 0 instance of cash out on our ATMs. By adopting redundant connectivity, we are able to maintain high availability on ATM. It is at 98.5%, which is one of the best in the industry. We have 35% share of the ATM transaction among the small finance banks. We will be piloting a few smart ATMs, which will allow cashless transaction, allow bill payments, and many more features. Ujjivan Smart Statement. This is a unique offering, which is highly interactive, provides a 360-degree view of all the relationship held with the bank. This interactive statement allows you to raise a request, customized view of your statement, right? This is an environment-friendly initiative also. We expect at least 4,000 trees getting saved in a year and much more in the years to come. We have put to use data science and analytics to gain insights. You would have heard in the talks made by my colleagues in their session. This we have put in place to understand our customer better, to understand their needs and behavior. I'm happy to share with you, we have been awarded by Quantic in recognition of an analytical tool developed by a bank for EMI imputation. This provides the true income of the customer. This also has resulted in a productivity increase of 100% in our straight-through processing. This also has contributed towards conversion of our unsecured portfolio by 13%, which Rishu briefly mentioned in his talk. We have also developed an app for our microfinance field team to track their productivity that has helped in increase of productivity by 18%. As spoken by my colleagues in their talks, we have implemented all the loan originating system now with customized workflows that has increased productivity and led to significant reduction in the sanctioning time. Some of the early indicators I would like to share with you. The sanctioning time of our gold loan, it has reduced by 1/6 from 180 minutes to under 30 minutes. Housing loan, the sanctioning TAT has reduced by more than 50% from 16 days to less than 7 days. Vehicle loan has seen a steep improvement from 10 hours to less than 30 minutes. These are just early indicators. This is expected to improve further in the future. With a formidable combination of digital channel, data sciences, and loan originating system, we believe we have the right ingredients that will resonate with the business plan that was covered by our Executive Director, Carol. Now, I hand it over to Mr. Sanjeev Nautiyal for his closing remarks. Thank you.
Good evening, ladies and gentlemen, our guests for the evening, and good evening to all my colleagues from Ujjivan. In fact, I am very delighted and feel very privileged to be standing here as a team member of Ujjivan, as an honorable representative of Team Ujjivan. So thank you very much for this opportunity. Mr. Martin dwelt on the digital part that Ujjivan is playing at this point in time. Mr. Davis and my other colleagues have elaborately detailed the business profile and its dynamics. Deriving from the above, the key focus for me in the bank would be as follows. Ensuring that bank's liability franchise is driven purposefully by increasing focus on retail and CASA deposits with wider sources of mobilization, lowering costs, and stable genre. Facilitators towards this would be strategies around excelling in customer service, tailor-made and value-added products and services, increasing our reach to the customers, and easy access for them through strong expanding multiple distribution channels such as our physical presence, digital banking, alternate channels, relationship managers, payment solutions, doorstep banking, phone banking, and many more such avenues. The other focus area will be to grow the secured book to 40% in the next 2 years. I understand this will compress the margins to an extent, but the right mix of high-yielding secured products in our suite will ensure only a marginal impact on the yields. Secured book growth will ensure a diversified loan book as a risk-mitigated and prudent profile. Our secured products have been revamped, refreshed, and extensively exhibit features like loan origination system, loan management system, automated underwriting, easy and convenient customer journeys and processes, digital documentation, and execution. We expect higher growth trajectory in our secured asset portfolio. With microfinance industry emitting signals of stress, we shall handle the evolving situation with care, diligence, and prudence, backed by our wealth of experience and expertise in this segment. Along with improving proportion of our secured book and growing the asset book sustainably, monitoring and maintaining robust asset portfolio quality will be a key deliverable. Ujjivan's asset quality and collection efficiency is among the best, supported by a strong collections team aided by analytics, strong ground awareness and connect, and AI ML powered early warning systems. Dedicated portfolio teams for monitoring are in place. Culture of digital prepayments is getting strengthened. Ujjivan Pro Collect app, a comprehensive tool, empowers collection. We maintain a healthy provision coverage of 87% and have additional floating provision cover of rupees 250 crores. Digital alternate channels and analytics. We shall continue to strengthen and embed analytics, AI, ML in our systems and processes and deepen digital penetration across assets, liabilities, payments, third-party products for creating customer delight. Rule engines and API integrations with various value-adding partners is bringing efficiencies, speed, and scale in distribution and in origination, underwriting, monitoring, collection, and early warning signals. We are working on data lake to populate information and data from multiple sources, analyze and provide actionable insights for upsell and cross-sell, and to also strengthen operational and hygiene areas. We continue to strengthen our offerings towards customer service throughout the customer life cycle based on customer segments and look to deepen customer relationships. Physical, digital, phygital, supported by tailor-made products, easy and convenient self-service digital channels shall be expanded and popularized. Our continuing investments in infra, tech, digital, and human capital will go towards building an excellent customer service paradigm. Reduction in cost of deposits and in other areas of expenses shall be focused. We shall drive income through third-party products, bank guarantees, PSLC certificates, and many more avenues that we have. We shall also work towards creating a strong brand image and enhance brand recall. I would now like to dwell very briefly on the universal bank license that the bank is aspiring to achieve from the Reserve Bank of India. You would be aware of the various categories and the criteria that the Reserve Bank of India has enunciated for a universal bank license, which is GNPA less than 3%, net NPAs less than 1%, net worth more than 1,000 crore, more than 5 years of satisfactory track record, listing on a stock exchange, meeting the prescribed capital requirements for SFBs. And of course, RBI would prefer players with a diversified loan portfolio. Ujjivan, as earlier Mr. Davis said, is one of the eligible players for being considered for grant of universal bank license. And I think there are multiple benefits that are going to flow to Ujjivan if it were to be granted a universal bank license. Reduction in capital ratio requirement from a capital adequacy perspective. It goes down from a release of capital of roughly 5 to 6% is what we are going to get. Priority sector lending targets go down from 75 to 40%. The small ticket loan imposition mandate that RBI has, 25 lakh tickets, up to 25 lakh ticket size for minimum 50% portfolio, that will also go away. I think depositors' confidence on a universal bank obviously is higher, more. Reduction in the cost of funds. There are many other activities of lending to mid-corps or to corporates, treasury activities, talent attraction. I think many more features and many more positives can be attributed to a universal banking status from a smaller finance bank migration transition. So we look forward to throwing our hat in the ring, and at Ujjivan, I think during this financial year, the bank would like to approach the Reserve Bank of India for a universal bank license and await their decision in the matter. So thank you very much.
Good evening. I think now we come to the most interesting part of the evening, question and answers. So there are two ways to do this. If you want to identify a person to ask a question, please state the name and the person will answer. If you want to ask a general question, then I will take the decision as to who's going to answer. So that's the two options you have. So please, feel free to start. Thank you.
Thank you, Team Ujjivan, for hosting the presentation today and for a very elaborate presentation. I'm Rikin Shah from IIFL Securities. Have a few questions. The first one is on the microfinance customers graduating into first IL and into other micro products. We have seen many NBFC MFIs and multiple other SFBs also going this route. However, what we have been observing is that the delinquencies in this new customers who are graduating into these products, it's probably 3 to 4 times higher than those segmental delinquencies. And even Mr. Chandra had identified that for the MFI customer base to go up from 8 crore to 20 crore, the JLG model needs to stay. But we are seeing many players moving away from it over a period of time. So the question here is that in this pursuit of diversifying and identifying new growth opportunities, how do you manage the risk and does that lead to higher risk down the line? So that's the first one. The second question I have is on the affordable housing. It's more of a directional question wherein what we are seeing is that many housing finance companies, the traditional ones, are also going down the curve and doing more of affordable housing. Is there a possibility that the pricing, which is very lucrative in this segment, can get impacted the way we saw it in the gold loans and the business becomes less attractive in the medium term?
Thank you for your question, and this is one question which we hear because IL is something which everybody talks about in microfinance industry, but very few players have been successful in the GL to IL graduation or open market customer graduation. The reason behind it, what we understand is because we have been doing IL for a very long period. We started actually in 2009, and then today we have 22% portfolio in IL. And to our understanding, IL is just something when you are building product, it is very, very different from JLG, typical JLG. It should not be understood as just an extension of ticket size. It is much more than that in terms of underwriting, in terms of processes. That is where I feel is that a lot of effort needs to be put. What I would tell you that, when we started IL program and then, the Andhra crisis happened, because ticket size was higher, we actually at that point in time we stopped IL. And after that, demonetization happened. Again, we felt that IL is higher ticket size, high risk, and we stopped IL for some time. During pandemic, we didn't stop, and we realized that IL portfolio is behaving better than GL. And that trend continues, because mostly you are graduating customers who are doing good in GL, and then you are graduating them to IL. So if you have right, the underwriting mechanism and good process for customers to, repay, because center meeting models goes away when the customers move from GLG to IL, and you need to provide them a convenient facility to repay. So if you have entire process and the credit policy which supports it, I think it is going to work. Customers needs higher ticket size loan. Customer also needs after some time to go out of center meeting and those processes. And if the demand is that, you have to find ways to have a product which match customer requirements. So far, I would say that it is a slow cooking food. If you try to cook it very fast, there will be some problems, and that is what I think you are mentioning that you have seen somewhere. But we have taken our time, and today we have very robust process of IL when customers are graduating, or even the open market customers graduate. We are not seeing any issue, even to an extent that IL is doing better than GL even during pandemic and after that as well.
Yeah, so on housing question, first I would like to mention two things, one internal to Ujjivan and one external. On internal to Ujjivan, as I mentioned, that we have done a lot of changes in last 2 years. And the changes that have been done to such an extent that we have customized our ROI to location, customer profile level. So, we have understood this segment so well that we are doing it on each and every parameter. On external factor, EMAY, as you would be knowing, is going to come around anytime soon. And we see a lot of demand uptake once it comes into picture, and it will be there for the industry overall. On coming to the specific question on pricing, yes, there will be competition, but as I mentioned again in the presentation, that on housing aspects also we are identifying profiles and locations where we can have a better margin. And on top of it, we have also started micro mortgages products, and it's a complete suite of product in itself. And there our yield is on a higher side. It is 18% plus at present. So I think if you have a balanced portfolio, we don't see any reduction, like any significant reduction on margin pressure for this particular business.
I'd like to add here that the new government, 3.0 Modi government, has already earmarked affordable housing as top priority and allocated funds. The first thing that they did was affordable housing. So affordable housing is going to be in the forefront and will have resources enough to go around to many players in the market. So I think for the next 2 or 3 years, there's nothing to worry about in terms of competition. There's going to be a lot of potential.
And so if I can ask one more question, which pockets are driving the upward revision in the credit cost guidance? Is it mainly in the microfinance portfolio or in some of the new businesses?
Yeah, it is only in the microfinance portfolio that we will see a slightly higher credit cost as compared to the last year. All the other portfolios, in fact, we'll see a much reduced credit cost in FY25 compared to FY24.
Thank you.
I think the important thing to realize is that this is an industry-wide phenomenon in terms of the current thing. We have, seen that and done our homework. We have reacted quite swiftly, and I think we have already put in place, measures to address this. I think that is the things that we have learned during COVID and during demonetization, and what we have learned, we have implemented. So I think, period of time, our slowing down, our responses will benefit and improve the portfolio and manage the portfolio better. And that's the objective. I think recognition is most important. You can always try to say it's not happening, but once you recognize this, you can react. And that is the difference that we have made this time.
Hello. Yeah. Hi, this is Kamal Mulchandani from Investec. Thank you for the presentation. I just had one question on the MFI part only. Could you please elaborate like what kind of stress are you seeing in other states? Like for Punjab and Haryana, we are aware of the Karz Mukta Abhiyan. But if you could just elaborate what kind of stress you are facing in other states and Kerala, of course.
Okay, in Punjab and Haryana, it was a very external event. It was largely from the Karza Mukti Abhiyan, which happened, which then became an Andolan kind of a thing. And you can see that the PAR for the industry has crossed double digits now. For us, we've been, we were quite sensitive to this fact, and we had slowed down in Q2 of last financial year. So we had reduced our disbursements in Punjab, Haryana. Right from then, for gold loan, new customer acquisition had stopped in Q2 itself. In Kerala, again, as we had started to see stress in the first half, in the first quarter of last financial year, we had reduced our NCAs, new customer acquisitions, and GL as well as IL have had a almost 0% growth for us in the last financial year. The reason is economic slowdown in Kerala. When we talk to customers, we hear that they're not getting salaries on time, their remittance incomes have come down. We have a limited presence. It's just a 2% portfolio for us. However, even that 2% portfolio giving a 3.5-4% NPA has been an area where we have been a little worried. But a small portfolio, no new customer acquisition, conversion from GL to IL. IL is, by the way, performing much better, are the ways in which we are preparing ourselves. Gujarat, we saw almost 28 new players in the last 2 years who started operations in microfinance. So I guess the discipline has got a little diluted. So as so many players came in, there was a free supply of credit. So that I would say is one of the reasons why Gujarat has not done well. Today, if you look at reports, you'll see about 7 or 8 districts getting impacted. While the economic slowdown, the economic activity slowdown has happened only in 2 or 3 states, 2 or 3 districts. So it's more, I guess, a supply issue.
Okay, thank you.
What I want to add here is that this is not a blanket statewide thing that we are doing. I think, Vibhas, if you want to add, because we have done hotspotting and found areas which are, troublesome. So we are not just blanketing the state and saying no business there. We are identified very clearly. I think Vibhas.
This is something which is, limited to certain districts, certain locations. Even we have marked certain villages and a certain number feet on the streets where we are facing issues and where remedial action needs to be taken. Most of these actions are proactive in nature. For example, you take example of Punjab. Our PAR versus industry PAR, the difference is 4% versus 20%. So when you see that your portfolio is being well, but the industry portfolio is not being well, it is always prudent to step back and see that what needs to be done there. And most of the steps that we are taking in those states are proactive in nature, but these states are not fully in some kind of problem. There are certain districts where we are seeing some stress, and those branches, those geographies, those villages are being managed differently, which we have learned over the period of time. We have seen that how COVID affected and how we were the first one to come out of it. And similarly, we have taken all the steps, and we are taking the necessary steps in these locations so that we manage the situation. But not entire Kerala or not entire Punjab or Gujarat is affected.
Okay, thank you. If I just may ask one more thing, like what is the cumulative write-off book which you guys are carrying as on date?
I don't have the exact number, but it is in the range of 1100 crores.
Okay, thanks.
Hi sir, Ashlesh here from Kotak Securities. Thank you for the presentation. First question is to Sanjeev sir. Sir, congratulations on the upcoming new role. Just wanted to get a sense, how has been your experience so far here? What do you find exciting? What are the new challenges that you are looking forward to? And secondly, how different or similar is this role from your role heading the FIMM department at SBI?
So I'm very excited, delighted and keen to be in Ujjivan. It's out of choice that I have opted for Ujjivan because an opportunity came by. I retired in from State Bank of India in September 2021, and with some engagements on my side, I felt I was fit enough, healthy, and still raring to go, and willing to move out of Lucknow where I had settled down, and therefore I am here in front of you in the city of Bengaluru. I find the small space very exciting because my last assignment was about financial inclusion and micro markets, and that too in the very, very challenging times of COVID. I joined in the month of May, and COVID had already set in. And then in September 20, the entire vertical moved to Delhi to be closer to the government. And that was not in response to COVID. It was designed in the manner to be shifted to Delhi so that we collaborate better with the government for the smaller loans and for the micro loans State Bank of India would disperse. So, and then we again came back to Mumbai. So we saw the small part of State Bank of India from a very close range and found that, this is a space where so much can be done. We were managing 70,000 customer service points where 40,000 crore of deposit actually resided. So, there is so much wealth at the bottom of the pyramid. There is so much demand. There is so much constructive demand at the bottom of the pyramid. We only need to believe in their strength. We only need to believe in their stories. And because of which, you can end up doing so much more. The team at Ujjivan is very vibrant. They work in a separate terrain than most public sector banks work. More on the unsecured side, more on the underserved, more on the unserved parts, and they have different templates, they have processes, they have technology, they have digital. So I think I am very, very happy, ebullient, and delighted to be part of the Ujjivan team, and I will do everything possible within my might to ensure that we deliver on the promises on the Ujjivan story. So that's how I would like to, put this across to you.
Actually, there's something that, after Mr. Nautiyal retired from, State Bank, he has been on the board of Life Insurance Corporation of India. So I think that, experience has also been very useful and will help us as we go forward. So I think that's so sort of wide coverage that we have, and his experience is quite wide that way.
Thank you, sir.
Had a question? Yeah.
Sir, can I go ahead with the question? Over here?
No, here there was. Okay. Okay, you have the mic.
Sure. So my first question basically is on the liability front. So, Joshua, in your presentation, you said that the dependence on the bulk deposits actually come down. But if you look at the numbers, it really doesn't show at all. I don't know whether there was a mistake in the presentation or what. That is number one. Number two is that across
there was a color code mistake which was identified.
Yeah.
We have to change that on the slide.
Okay, sure. And so basically, when we look at the entire bank model now, we are more moving towards secured long tenor loans as such in the entire product portfolio. How do we plan to basically manage our ALM? Obviously, we have to reduce the dependence on the bulk deposits, focus more on retail TDs, and they are basically also into the long term as such. The current account proposition that you're talking about, and this is basically something which everybody does, right? But if you look at the regional private banks, none of the regional private banks have actually been able to crack the code on current deposits. So what is different that we are going to do? Penetrate more into the SME, the mid corporates as such that basically we'll be able to garner the current deposits. If that doesn't work, then basically you have to fall back on the saving deposits. There also a record actually has not been that great as compared to what basically happened with Bandhan or earlier part of even Equitas. So what is your thought over there? So basically I just want to pick your brains, and then maybe Ittira Davis or Mr. Nautiyal can actually add to that.
Okay. As I told you, bulk deposit percentage wise it's reduced by 7%, and individual deposits it's increased by 7%. So overall bulk deposits to the total bank deposits now it's less than 30%. And this current account side, as I told you, there are some larger companies we may not able to enter because they have a loan relationship with other banks, kind of higher OD limit more than 5 crore. We cannot able to open current account with these higher segments. So this year, mainly we will focus on the retail current account segments. So smaller traders or small kind of MSME customers, maybe supplying raw materials to the bigger manufacturing units. So there's that kind of segment we can give current account services to these people. So for them, anyway, we are closely working with MSME segment for asset side, and the liabilities solutions we are adding many solutions to these customers. So with this proposition, we can acquire the small or mid-size companies. We can give current account facilities.
Yeah, I mean, there are several features which are there in the market which we can use. Like today we were talking about sweep accounts. I mean, it's an expensive proposition, but when you look at the average cost, it is still considerable, something that we can look at. So what I'm saying is that, there are features which we have not yet used, which we can introduce. And our objective is to take the CASA from 26% where it is to at least 30% in the next 2 years. Now you may say 4%, but 4% is a big move in CASA. And if we can achieve it in 2 years, I think it'll be a considerable achievement. Because some of the banks, we unfortunately didn't open our banking system 2 months before demonetization. Had we had that, then we would have benefited. Some others benefited. But that's, water under the bridge. But going forward, we have to adopt the best practices which are there in the market. And we are quietly monitoring the competition. And we will add features to our product as and when it is required to get that to the 30% in 2 years.
So I think current account behaviorally is linked to the small and the medium enterprise, and of course the mid-corp and the other parts of the value chain are beyond the scope of Ujjivan Small Finance Bank. So as the MSME part plays bigger role in Ujjivan's architecture, the concomitant benefits of current account opening is bound to increase. And I think with increased focus and increased efforts, this is going to tie up with the entire story. Liability franchise is never easy for any bank, for new age banks, for new banks, especially small finance banks. Some small finance banks may have had historical reasons because of which they have more deposits coming into them. But Ujjivan with a microfinance, genre, I think is alive to the reality. And I'm sure with adequate focus and adequate bundling of various services that are required for a current account holder, as Joshua mentioned about the current account roll down that is going to happen in the next 3, 6, and 9 months in a phased manner. If we bring that value to the current account holders, I'm sure they are going to bank with Ujjivan, with cash management products, with QR codes, and all merchant solutions riding on current account. It's going to be a different story. So more efforts on the ground, creating the right conducive architecture around products that should help solve the issue.
Sure. My next question.
And a bit from what we are doing on the MSME piece, we are not focusing on big corporates. Our focus is on retail MSME customers. And what we are distinguishing ourselves on is we have now a dedicated team that we have hired from experienced business banking teams from our peers, right? That sits very differently from our legacy term loan focus that we have had. And the idea of creating this dedicated business banking franchise was to have relationship managers that understood the customer's liability relationship in addition to providing the funding solutions. And they carry targets of getting customers to bank with us solely. And these ticket sizes would be around 75 lakhs to 1 crore on the funding side. So we are not looking at, customers who are in the corporate side of the fold, right? And with the synergy that we are having with branch banking, our relationship managers are based out of branches. They are doing joint customer acquisition with the branch banking team. It's a slow burner, but it is starting to scale up now. On a very, very small base, we have seen our current account book doubling up on the MSME side, the MSME mapped current account base. So that should give a more relationship-focused current account acquisition tool And we are really not looking at flashy, large-scale acquisitions. It's a hard work getting to more retail car acquisition and family banking coming to us.
Sure. My next question is to Ashish. Certainly due credit to the way basically you pulled out Ujjivan out of the COVID stress that we had seen. Now we are into a new cycle where new businesses have been added. And we've been talking about now 1.7% credit cost, wherein basically we had significantly higher PCR. We're actually trying to bring it down. A lot of other players basically have talked about building contingent provision buffers and taking the credit cost about 2%. So you have a buy-in basically on this 1.7% credit cost, or you believe that bank basically should have relatively higher credit cost guidances and higher provision buffers as such in place? So what's your thought over there?
So when we look at the pattern, the pattern of slippages, the pattern of recoveries, Q1, Q2, Q3, Q4. Q1 and Q2 gave a different story. Q3 and Q4 gave slightly higher slippages. Parallelly, there was a slightly higher credit cost in Q3 and Q4. When we do a simulation for the full year, we feel that it is more than adequately covered. We also feel that in Q3 and Q4 of this year, while the credit cost will go up, but the slippages should start to come down. So our incremental credit cost for Q1 and Q2 of next year will be hopefully much lower. This year, because of slippages that have happened, because slippages ke baad, it is almost, a 12-month story. For 12 months, provisions are at 90, 150, 180 and 360. So till 12 months, you have to see some kind of provision increase. But at one point, we had initially said it will be in the range of 1.4 to 1.5. But when we look at a stress scenario, I think 1.7 is more or less should cover it. In terms of floating provisions, if we see our NNPAs going up, slippages going up, at the end of the first half, we'll take a decision accordingly.
But 1.7 is for FY25, right? Going ahead into FY26 and all, we'll take it above 2%?
No, I don't think so, because from what we see on a day-to-day basis, talking to our branches, talking to our people, they say that the conditions in stress areas are significantly improving. So in Punjab, for example, there were 4 districts which were impacted: Amritsar, Jalandhar, Hoshiarpur and Gurdaspur. These 4 districts have shown very good collections in the last 2 months, in the months of April and May. In Kerala, we have about 14 branches. 8 or 9 of them have got impacted. It's a 2% portfolio. We hope that it will take care of a little bit of extra provisions. In Gujarat, at the end of Q1, you will see that a lot of people have stopped or slowed down their disbursements. It's something that we also understand from all our branches, that people have who were lending very aggressively have slowed down their disbursements. In our top 5 states, which is Karnataka, West Bengal, Tamil Nadu, Bihar and UP, we don't have a PAR of more than 1.4 to 1.5. And our NPAs are in the range of 1.1 to 1.25. So in smaller states, yes, there is a little bit of slowdown, moderation that we need to see. But in the larger states, there is no need for an additional cover of credit cost.
Last, very quickly, sir, the the Universal Banking Guidelines, it talks about the diversified portfolio. Based on the current assessment, do you believe that we have enough diversified portfolio to be eligible for the RBI's clearances, particularly on the Universal Banking license?
Yeah, that's a good question, because that's the one aspect which is qualitative rather than quantitative in the guidelines. Now, when you say diversification, all of us will think only about assets, secured, unsecured, whatever you have. But in a banking industry, diversification is much more than just assets. It is the liability side of the balance sheet. It's the products that you have. It's the geographic coverage. Ujjivan is second to none in the SFBs in terms of geographic coverage. We are in 26 states. And interestingly, in none of the states that we have a big portfolio is more than 15%. Even in the home state, which is Karnataka, we are below 15%. So that is an indication that the top 5 states where we have 10% or over in portfolio. And in the next year or two, we like to grow in the states where we are below 5% or 5% and thereabouts. So that is the type of diversification which we believe the RBI is looking at. Assets is good. We will continue our diversification from 30 to 40%. And if necessary, discussions that has to go up further, we are happy to consider that and look at it. But, we have a setup for financial inclusion. And even a universal bank, I think RBI and the government of India wants financial inclusion as the main driver. And that is something that we are far ahead of everybody else in terms of providing. So I think when we look at diversification, it's the whole banking product diversification. And I think we have met that, or we will be able to meet that objective and target.
Thank you and best of luck.
Yeah, this is Shailesh Kanani here from Centrum Broking. Vipas, in your remarks, you had talked about optimistic about second half. I think Ashish has alluded to certain points to it. If you can add, okay, what makes you optimistic about second half and what are any key monitorables for us? And also about UP as a state, if you can throw some light, if there are any stress levels, because some of the reports are mentioning UP as a state also having some issues with respect to collection efficiency. If you can talk on those 2 points.
So, wherever in districts we have stress, there are certain locations where stress is more of local societal problem or local political level problem, which generally stays here for 3 to 4 months, 5 months, and especially after the elections, we are seeing some relief also. So our belief is that based on past experience, these locations in next 2 to 3 months, they will normalize. And then a normal microfinance process can happen there, which is at this point of time, as Mr. Goyal was mentioning, that we have, to an extent, we have restricted new customer acquisition, top up, etc. That can be removed. There are certain other locations where we see that that there are little over lending happening, and there we are also seeing that the smaller players who have entered into a state after pandemic, they have also slowed down because of various issues, their portfolio quality, liquidity, etc., and that will also ease out once the smaller players, new players slow down, because number of players entering into the same market at the same place actually overcrowd the place, and chances of overlending increases. That also in previous crisis, the pandemic, and before that, just before pandemic and after during Andhra crisis, we realized that this is something which is normally normalized in 6 to 9 months of time. 3 months we have already seen. This started happening around November, December, as per the, if you look at data carefully. So that, these data point and so far our experience says that it, in the most of the locations, in the second half will be much better than the first half. And your second question was?
UP state.
UP, so far, UP has been very good as far as portfolio performance and overall business is concerned. We have concern in 2 districts, I guess, Faizabad and one more district, where we see some kind of a state, but overall UP state is not a bad state for us. In fact, after pandemic, UP was one of the states which recovered one of the fastest in terms of overall collections and business development. So far, it is not in our watch list. There are certain districts and locations where we are careful.
I'll just add to that. We are present in 29 districts in UP. Our non-delinquent collection efficiency is in the range of 99.5. PAR was 0.65 last year. It has gone up to 1.2. So we're not worried about a 1.2 PAR. And our NPA is in the range of 1.05. So 7% portfolio, there is a lot of headroom to grow. We have in fact added 25 branches last year. There are some pockets. There is a Agra, Firozabad, Hathras. That's the triangle which has seen an NPA of greater than 2%. But overall, out of 29 districts, there are only 5 districts that has an NPA of more than 2%. So 24 districts, we've not seen any deterioration in portfolio quality.
Thanks.
I just want to add one thing. The other thing is that the country was operating on an interim budget up to now. So July we'll have a full budget, and I think with the resources that the government has, there will be some more spending, and some of the stresses we have seen will perhaps go out with that. Now, having said that, we are not becoming complacent. We are keeping our watch and looking at it quite carefully. And I think what my colleagues have said will hold out, and hopefully the second half will look slightly better. Your second question.
Yeah, last question. Any nudge from the regulator with respect to rates for the MFI business? Any comment on that? Because we keep on hearing about that.
So you are talking about interest rate.
Right, right.
That is something which is, there is a discussion, there is, but at the same time, what I would like to say that in terms of interest rate offering to our customer, as far as Ujjivan is concerned, we are, at a price point which is very, very responsible pricing. As far as the discussion around it, because of exorbitant rates which some of the players are charging, but we find ourselves safe. If something like that also comes, we should not be affected.
Thanks a lot.
What I want to add here is that, in the last 2 years, when RBI raised repo rates by 2.5%, our microbanking rates we raised only by 100 basis points, by 1%. So we have given, in fact, our cost, we have given to the customers 1.5% concession, if you want to call it that way, because we felt that the economy was recovering, the customers were coming out of a hard situation during COVID, and it was our responsibility to help. So that is what we did as a sort of, we mentioned that to the RBI as well. That is the way we have responded.
Thanks a lot, sir.
Yeah. This is Gautam Jain from GCJ Financial. Thank you, Team Ujjivan, for hosting this annual Investor Analyst Conference, which gave us the opportunity to interact with you. Thank you for that. And thank you, Mr. Davis and team, for doing such a wonderful job in last 3 years, which actually created a lot of wealth for the investors. So thank you so much, and best wishes for the future. Coming to the question side, first to clarification. So you changed your guidance within 1 month. I think post result, we were quite optimistic on growth and credit cost. So good that you changed, seeing what's happening on the ground and with time. And it's always good to achieve better than what you commit. So by assuming you will deliver better what you commit. So overall growth, we say 20%, and in housing and SME, we are saying 40-50%. So microfinance, are we assuming around 10% growth?
So overall, yes, we are changing the guidance to 20%. Obviously, housing will grow much faster, above 40%. Within microfinance also, IL will grow continue to grow faster. Because this GL to IL graduation will continue, because we will have good customers in difficult areas also, and these difficult areas are in certain pockets only. So overall we will be at 20. Microfinance, a real guidance also, microfinance was with a larger base in the lower side. Now also with 20%, microfinance will be on a little lower side than the average Ujjivan growth. But numbers is something which is something which will be, we have to see quarter by quarter, look at how the situation is, and we may increase or decrease based on the situation.
Okay. Second clarification on Ashish, you said recovery this year also could be around 135 to 140 crore, right? Which we had this year?
In the range of 100 to 125.
Okay. The question is on the OPEX side. So what kind of OPEX growth we have built in our model this year, FY25?
The OPEX that we have looked at is, we have to, based on the developments on the microfinance, the OPEX cost will also have to be revised. So it's a dynamic model. We are trying to, last year it was 55%, the cost income ratio. This year we would have seen it go up a little bit, but given the current scenario, we are trying to make sure that we respond even managing the costs downwards, so that overall the numbers look good, and that is something that we are working on. So obviously, if we are not dispersing that month, we don't need that many staff that we had planned for. So we will be making changes on that front as well to bring down the cost, and we hope that we can keep it in the 55% range cost income ratio that we had last year.
The 20% ROE and 20% growth is commendable. It's very good. Second question was on Mr. Nautiyal. So your key finding so far, and any strategic change you want to do in Ujjivan with the business model, key priorities in terms of diversification or expansion plan, anything you want to share?
I think there are so many things under the current dispensation, I would say, there are many initiatives which have been rolled out, maybe last year. Some are halfway through. So there are many verticals which are in different phases of maturity or culmination. I think there is so much more to do on those sides at this point in time. And also because of the MFI stress, I think it would not be proper to suggest or to recommend any strategic kind of an initiative at this point in time. And with only 15 working days at my disposal so far, it would be a little premature to say anything on that. But certainly, based on deliberations and suggestions of the leadership team and the teammates, we will certainly look to scale up certain things, bring new initiatives, give more thrust to certain areas which may be dormant, which happens in any organization. But that's a call that we will all take together once I'm, more at ease with the number of days that have passed in Ujjivan.
Thank you. All the best.
Davis sir, first of all, thanks for alerting us on the ground of what's happening in the microfinance business. And I'm sure next week onwards, we'll see many more companies trying to inform shareholders and analysts as to what is the ground situation. Being an optimist, because that's how I believe you make money in the market, when do you think, if things are better, you would try to sort of change the guidance that you have given on this subject? So let's say we are now in June. If by December end you find that the pockets of stress in 3 or 4 of those states have improved significantly, would you then be in a position to sort of turn around and say, okay, things are now under control and we believe we are back on the fast track? Because you've done a lot of micromanagement and you have actually drilled down district-wise, village-wise. So any take that you would have, Davis, and also then Vibhas?
I think it is our responsibility to tell the investors and the community as soon as we are aware of any such thing, and that is what we have done today.
Correct.
Now going forward, the first quarter is almost over. So, to give any other guidance in the first quarter is unlikely. However, in September, at the end of the first half of the year, if we see any significant change, we will make an advisory on that front when we announce our half-year results. Otherwise, every quarter, December quarter is another opportunity for us. But, anything that comes in between which we feel the investment community, the business community should know, we will advise immediately. So I think for us, the next milestone on a normal course of events is the half-year results, which will come out in October. So I think that was the likely time. If there is any change, any positive or negative, that is the time which we will announce it.
Sir, second question. The budget would be announced probably in less than a month. So we have the entire leadership team here. So while there have been some announcements on the affordable housing, anything else you believe could come with the banking or the SFB space, which could be a trigger for our kind of company?
I think, there I would go back to the Prime Minister's speech at the 90th anniversary of Reserve Bank of India on April 1st, when he mentioned that financial inclusion is the most important part of growth in the country. And I hope that the new budget will address that in addition to the affordable housing. So if that is put on the agenda, that will definitely help us in our business.
Thanks.
I wanted to touch upon the comments you all made on the MFI side. So it would appear that apart from Punjab and Haryana, the other states that are facing stress seem to be either economic linked or too much supply of loans. Is that just in those states, or is it prevalent in other states as well, where you may not be affected but others are affected? That would be the first question.
why would you not expect that in other states where there's also been a large increase in either the number of lenders or generally borrower ticket sizes, etc.?
So, we have seen stress in these states, certain locations, certain districts, not even in other districts of these states also. Because if you see the pattern of number of lenders, especially after any kind of difficult phase turbulence, a lot of players introduce some other state because they face problem in some other state before the turbulence. And they move to a certain location, certain district headquarters only, and that geography only is affected. And if you have presence, you are open your branches carefully in white spaces where you see less competition, you will not be affected. You are right. Maybe in other states also certain geographies will be heated. But if your branch opening strategy is right and you are present in location where not many players are there, you will be still unaffected. And this is what we have seen in other states as well, because our branch opening strategy has been very, very stringent, which is again unique, unparalleled. We have a very unique branch opening decision-making process. As far as Gujarat, Punjab, Haryana is a different problem altogether. It is not over lending in Punjab, Haryana. The number of lenders are not many in Punjab, Haryana. But yeah, Gujarat to an extent we are seeing that also in Gujarat because of downturn in diamond industry and textile industry, that has also resulted into business or income loss of customers. So yes, other states also there might be some locations where it has happened. But if you look at the average OSP per customer in different geography based on the credit bureau data, that also varies significantly. For example, Bihar may be the number one state in terms of microfinance OSP, but the OSP per customer is still 60,000 only. So that also tells you a story, whereas in Tamil Nadu it is close to 1.7. So that also, based on the population potential, etc., we have to see that each district, how it is behaving and how many loans are being disbursed. The average loan at industry level is only 1.9, though we might have heard stories of customer taking 10 or 15 loans after removal of three lenders rule, but the average is still 1.9. So yes, some places in other states might also be affected, but these will be mostly the epicenters where all microfinance companies go and start branches there. Those will be these locations.
So and
add to that.
We have mature states, which is the top 6-7 states, which, TN, West Bengal, Karnataka, Bihar, UP. Bihar, UP are now the big ones. Bihar is now the number one state, almost 60,000 crore portfolio. If we look at these states, which are the stable, old states, businesses more than 15 years old, there are certain areas. For example, in TN, there are Tirunelveli, Tenakasi, Madurai, Dindigul, that area, which has shown an increase in delinquency. But it has not gone beyond 2%. The NPAs have not gone beyond 2%. In UP, there are again 4 or 5 districts, again the Agra, Hathras, which I was mentioning. In terms of runway, there is a lot of runway still left. We, as I was mentioning, opened 25 branches in UP last year. We opened about 12 branches in Bihar. So these mature districts, mature states, we don't see an issue. If there is an issue, it will be with the newer areas where customers have not matured, practices have not matured. Gujarat is an example. Punjab, Haryana are also examples because the practices have not matured there. A lot of focus is being, done on our credit underwriting processes, our people going and meeting, supervisors going and meeting customers. So we believe that in mature states, we should not see stress as we see in the smaller ones.
So, I mean,
one more question.
I just had a small follow-up on that, if you can.
Do that, but after that, we'll be meeting outside.
Sure.
We can have one-on-one discussion.
Sure. So, what it would appear is what you're saying is that in many of these districts or areas where there's a problem, it seems to be more of over leverage, either because the customer's income has suffered or because there's been too much lending or some combination. So why would you still be confident on the individual loan business then? Because I would expect that there'll be higher risk there. So, I mean, would that not be a general slowdown that you would want to do on the entire piece?
The income segment and the occupation segment of individual loans are much higher than the group loans. So in individual loans, typically the average household income goes beyond 40,000 per month. So there the incomes we are talking about is about 4.5 to 5 lakhs per annum versus a 2.5 to 3 on the group loan. And that is how the graduation also happens. On the occupation side, we see a lot of business loans, a lot of livestock loans, which are going into individual loans, and higher incomes are also putting their money into home improvement. So this looks like a more stable portfolio. This looks like a higher income, more purpose-driven business, livestock, home improvement. So therefore, it's more stable as we've seen. We have also studied in the last affected districts, is individual loan also giving trouble? It's not. So we feel that's much better.
Thank you.
Adding to what Mr. Aziz said, is that what you saying that around IL is because of higher ticket size, high risk, and that is something which we all also believe, though we started IL long back, and we started as I said in the presentation. But at the same time, first of all, customer segment is different. We choose customers, and the underwriting methodology very, very different. We have independent credit team where we not only customer but the customer husband also becomes co-borrower. We also analyze businesses of these customers. Second, the data that because we are doing IL for a very long period of time, and now when we go back and see the affinity towards taking further loans is higher in GL than IL. The reason might be because IL you get proper ticket size, you don't tend to take further loans. The problem with GL is that you don't get a proper ticket size and then you move to the other lender also. In IL, the tendency of taking further loans from other players is much lesser than what you see in GL.
Thank you.
Hi,
one last.
Sure, thank you so much. This is Chintan Shah from JM Financial Family Office. So one question again on the microfinance piece. So you earlier mentioned that microfinance works in cycles. So now if you see the past 2-3 years, we've seen a good cycle. And now if you see there's increased competition, however, there are a lot of changes that has taken place in terms of regulation as well. So what gives us the confidence with the stress coming in, competition increasing, etc., that we're not entering, maybe not in a jiffy, but gradually in a down cycle? That is my first question. Second, I wanted 2 data points. One is the stress areas. If you can just quantify in terms of percentage of UNMU, etc., what would that be? And second, you gave a credit cost guidance of around say 1.7%. So if we compare it with pre-COVID, what would that number be? Those are the 2 questions that I have. Thank you.
Second one, I will give it to Mr. Aziz because a lot of data you are asking for. As far as business, what gives us confidence that this is something which is not can be compared with say previous crisis. So take example of pandemic, which was altogether different story, and demonetization, which was almost sudden. Well, you don't know that it is going to happen. And before that, Andhra crisis, which happened because of what are the reasons behind it. This is something which will be much smaller, much slower, and to a limited geography. What also gives us confidence in this regard is that this industry has become mature. We are not in 2011, which was during Andhra crisis, where there was no credit bureau, there was no understanding between players who are working in the microfinance market. Today, we have a very strong, cohesive team and self-regulation body also. And this is something which is being discussed among the players also in MFIN. And we are also expecting some self-regulation also coming in, which will be followed by everybody. And this is something which is in advanced stage at this point of time, which will also lead to some kind of control. So that gives us confidence. First of all, it is not something which is sudden across the country. And second is something which is, as the industry has matured, there will be some decision which will be taken among ourselves also, which will be implemented, which will give some kind of control.
In terms of credit cost, see, there are 2 ways of looking at credit cost. One is look at a 5-year credit cost. Because when we talk about an industry and cycles, it's prudent to look at 5-year credit cost and then average it out over the last divided by 5. If you look at that, maybe you will find that a microfinance industry works with a 1.5 kind of a number over a 5-year period. One accounting change that has happened is bad debt recoveries don't go into netting off credit cost. They go into the other income. So that again is a 0.15 kind of a number. So if you look at it, earlier it used to be in the range of 1.2, 1.5.
pre-COVID. Again, a 5-year cumulative number. Today, again, we are talking about similar kind of numbers. So not much has changed, except for the bad debt recovery.
The reason I'm asking is because now the data availability in terms of bureau data, that is better. And based on the past experiences, definitely we have been working on our processes, etc. So that is why I wanted to see if pre-COVID, what was the range? Is it now with the stress coming, is it lower or is it not lower? That is all the sense I'm trying to get at.
So again, pre-COVID, if you take an average of about 1.2, and today we look at the 3-year cumulative number that we are delivering, we are talking about delivering, we are talking about a less than 1% again. Because for 2 consecutive years, we didn't have any significant credit cost at all. Our recoveries were completely covering up, knocking off the credit cost.
Got it. And the percentage of the book that is under stress?
No, we don't have a number on that. We can only say that in terms of PAR, we are in the range of about 3.4, 3.5%.
Got it. Understood. And one last question. So with the changing mix, 60% unsecured and 40% secured. So with what should be the sustainable ROE number that we're looking at, say from a medium-term perspective, FY25, I know you have given a guidance. What would be that sustainable number with the mix that will be going ahead with?
I think the ROE number, given the reasonable good credit or normal credit conditions, because it is linked to that as well. I think, with the 60-40, 20-21% is doable as an ROE.
Assuming this credit cost guidance 1.7%.
Yeah, it's on the, it doesn't go on the extreme. If it's on the 1.2 to 1.5, which is a normal, 5-year average, we should be able to get the 20-21%.
Oh, got it. Thank you so much for answering my questions.
Thank you for joining us, and please join us for drinks and dinner. And if you have any questions, further questions, we'll be out there to answer them. And thank you very much.